So there are three main cryptocurrencies, the market leaders, if you like: Bitcoin, Ethereum, and Ripple. They all do different things, okay? And they all have different purposes. Bitcoin is the market leader because that's the one that everyone knows about. Ethereum is a distributed computing network, so it's like look at Amazon Web Services effectively, but it's completely not owned by anyone. It also is completely autonomous. And Ripple is a liquidity provider effectively. That means that you can send transactions very, very quickly and very, very easily using its network anywhere in the world. I've personally seen a transaction of $300 million go through the Ripple network for 3 cents. That was the fee that was charged. Where if you went through a bank and did that, it would cost you several million just in fees. There are caps and finite limits to the amount of cryptocurrency that can exist as part of their design. 21 million Bitcoin can only ever exist. We're at about 18.5 million now that have been actually mined and created. 120 to 140 million Ethereum, we're on about the 110 mark at the moment. And 100 billion XRP, we're on about 50, but they're actually pre-mined. They're already created. They're not actually mined as part of the process. They all exist. They're just held back. And Ripple is the one that's been gaining the most traction because it's run like a financial services company. It's not a distributed network like Bitcoin and Ethereum are. Ripple is actually, they can understand it. FinTech can effectively understand Ripple because they're run by Ripple Labs. It's all centralized. It goes through the same process, but they use cryptographic technology in order to secure the transactions. Big users of Ripple are American Express, Santander, Barclays, HSBC. They've used Ripple extensively over the last 2 years. The chances are that if you've banked at all internationally or had a payment service through a credit card recently, it would have more than likely used the Ripple network as it's part of its process. So effectively what we have here is a difference between a correlate and a crypto. Because the market size is capped, the more money that gets introduced into it, the higher the price. Whereas with a correlate, because it's always got something missing, because we can always create more of something, more property, more bonds, more government debt, more anything, it doesn't cap, it doesn't affect the price, it just ticks along slowly. This is why we see the exponential returns, okay? Because the market cap is finite, given a space. If suddenly a load of capital gets introduced in that space, the asset price does this. So it's an exponential market as opposed to a linear market because over time, the linear price just increases per unit, whereas when we introduce a lot of capital, we see an exponential curve. So what's the problem with fiat? Why can't we use normal money? You know, if I have a £5 note in my pocket, what's wrong with this? What's effectively wrong with this? Well, this is just a promise. It's a promise to pay the bearer of the sum £5 at a future date. And as long as we keep this in circulation, everyone knows I will get £5. But what actually is £5? When fiat currency was actually introduced, it used to be backed by metal, gold and silver. It used to be asset-backed, okay? Back in September 1931, the US decided that the dollar was no good. And then the Bretton Woods Agreement came into effect, and every fiat currency from there on, all 115 of them, has not been asset-backed, okay? When the pound was first introduced back in the 1700s, it was worth 12 troy ounces, which today, if it was on parity, would have a value of £200, okay? So this would be worth £1,000 if the value had stayed constant. The pound is now worth 0.05% of its original purchasing power. In fact, every fiat currency on earth is in a race to zero purchasing power. We've seen this in Venezuela, Weimar Germany, etc., Hungary, for example. There are currently in the world 10 fiat currencies that are over 10% inflation, which means that a year ago, it costs you 10% more now to purchase what you could for a year ago. In Venezuela, in April 2019, inflation was measured at 298,000%. That's what happens when a fiat currency goes to zero and everyone loses faith in the value of that asset. We call this systematic devaluation, inflation, and central banks and governments have a target around 2% a year. There's a target for how much your money loses value over a given period, i.e. a year, and that's generally set at 2%. This £5 note, if you take it back a decade, is now only worth probably about £3.50 in terms of actual purchasing power. So if you had a £50 note from 1981, when the £50 note was first introduced, it's actually worth £13 today. If held for 50 years, for example, in a cash pension, it's actually worth £2. So we have very much of a problem with fiat currency in that it systematically devalues over time. You can actually see this This is the purchasing power of the pound from 1975 to present day, effectively. And as you can see, systematically getting lower and lower and lower and lower. It does drop off eventually with a sudden drop, but that sudden drop is hyperinflation, where the complete currency goes AWOL, effectively. Governments have two options in this circumstance. They can either replace the currency, as happened with the euro, where 15 currencies got replaced between 1999 and 2008, or they can adopt another technology. The end game for an overapplied currency is hyperinflation. That was what was used to purchase a loaf of bread in that currency. The world is $250 trillion in debt. That's not personal debt, by the way. That's government debt. So effectively, every man, woman, and child owes £25,000 just for using fiat currency. Okay. That's actually just crossed over the $250 trillion barrier for the first time ever. World assets, just in case you're wondering, $544 trillion. So effectively using half of the net assets of the world in debt at the moment. And that's just not staying there. That's accruing at a 4 to 8% interest, compounded every single year. In America, we've taken on an additional $1 trillion worth of debt every single year since the current president came to power. It's not looking good for fiat currencies. So how can we stop this? Well, the short answer is you can't, really. It's too much of a big problem now to actually yield any significant change. You could, of course, raise taxes to pay off the debt. That won't be particularly popular, but you could, over an extended period, maybe 40, 50 years, pay back all the debt that's needed with a phenomenal tax overhaul. Or you could switch to an asset-backed style of currency. Unfortunately, in the world at the moment, there's no asset which is worth $250 trillion, especially a real asset as opposed to a synthetic asset. The only option we kind of have is to abandon fiat currency altogether and start with something new, something fresh, okay? Something like cryptocurrencies. So Bitcoin was once worth $0.1, 10 cents, effectively, back in 2010. I have clients who remember being offered Bitcoin, 50 Bitcoin for $5, effectively, £5. They thought it was just a fad. They didn't think it had any long-term viability, so they didn't take him up on it. Today, that will be worth around about £450,000. Today's prices will almost be legendary in years to come. People will look back on these prices. Bitcoin right now is around 7,000. Ethereum is around about 100. And Ripple is around about 15p. They will look back on these prices and think, goodness gracious, why didn't I invest? Why didn't I do anything? And extrapolating out from these charts, as we can see, gives us the prediction of where Bitcoin is most likely probabilistically to be in the course of the next 20, 30 years. So this is a chart where I've done exactly that. So you can see the first generation here, this is the big spike. Then we have the second generation peak. Then the third generation peak at the top there with 20,000. And then fourth generation peak will be somewhere between 80,000 and 500,000, probably closer to 500,000, because when the market takes off again, everyone will want to, what's known as FOMO, which is fear of missing out, and buy regardless of the price. So in actual fact, the majority of Bitcoin was actually bought over 10,000. People didn't buy it at 5,000, 4,000. They bought it at 10,000 because they suddenly had validation for buying something that was going somewhere. What happened? They went up to 19,000 3 weeks later. Majority of people didn't bank their profits because they wanted it to go to 25,000, and it came slamming back down to 3,000 over the space of 9 months. A lot of people sold out right at the bottom because they were fearful it was going further. So effectively, you have this paradoxical way of investing where you buy high and you sell low, okay? Because you're not actually doing what you should be doing in terms of holding when you should hold and selling when you should sell. How can you profit from this? So investing now when prices are relatively low is key, effectively. The market will do most of the work for you when it takes off. Trading in and out of the market at key price points is what I specialize in, and it's a way to compound your investment, because if it can make you double your capital in the space of 6 months, you then have a lot more capital to add to your arsenal when the market does start its massive movements, exponential movements, effectively. Just out of interest, we've got a situation where I can actually show you the median price. You can actually see this. So the number of users here is the black line at the bottom, okay? So these are the number of people, 8 million of them, okay, at present time, who will never sell their Bitcoin because they're vested in this going to 500,000, okay? If the price came down to $1 tomorrow, they just buy as many as they possibly could. And because the asset price is fixed and the number of units are fixed, they will be able to do that and push the price back up very, very quickly. Then we've got the median price, which is the dotted line. That is the average price over the past 10 years or so. As you can see, despite its volatility, it has always been on the increase. Okay, so we've seen a constant increase in the price over the last 10 years, regardless of what the volatility experts claim. Okay, and then obviously the dotted line at the top is the potential highest price of this movement. Okay. So what are your expected returns of investing in cryptocurrency at the moment? So if you put £1 in Bitcoin at current prices, you can expect to make £20, okay, over the next 5 years. Ethereum, £1 will make £30. That's because it's got a wiser user basis and there's more capital deployed in Ethereum because it actually has programs that run on it as opposed to just being an exchange of value. Ripple, £40. That's just because it's the cheapest asset class at the moment. Theoretically, during 2017, it went to $3. 15 cents all the way to $3 is a phenomenal return, which won't be able to be formed by Bitcoin because it's currently a lot more expensive and therefore takes a lot more capital to rise, for the price to rise effectively. Thank you very much for listening. Just in case you're wondering, that is an exponential growth, and that is my book that I'm publishing next month on cryptocurrency profits, which effectively takes you much more in depth as to what I've talked about today, and goes on a little bit more about how to trade effectively, when to buy, when to sell, and trading signals, etc. So, thank you.